Hi, folks. This is Sean Hyman from the Logical Investor, and I want to talk to you about Elliott waves. They're one of the tools in my tool chest. Many of you know I have a three-pronged approach. The first and foremost, and what is most foundational, the one that matters most, is fundamentals, which is the size of the company, amount of cash it has on its books, amount of debt it has, its earnings, the price of the stock relative to its earnings, et cetera, which is also known as a PE ratio. Several of those components, those are the most important because it tells you how solid a company is, if they're making money or not, if they've got a lot of cash or not, if they've got a lot of debt or not. It's all stuff that would matter if somebody were analyzing your own personal balance sheet to take a look at you to see if they want to take the risk on you for giving you a loan or things of that sort. And it's the same thing that we need to look at when analyzing companies. So that's one of the pieces, the first and foremost piece. Then secondarily, there's technical analysis, and thirdly, there's sentiment. And so I want to talk about Elliott waves because they have to do with the latter two pieces. Technical analysis is just simply charting. It's what you see on charts, and it's how you tell what is likely to happen in the future by indicators such as the MACD or moving averages, which are these blue and red lines here, or the RSI, Relative Strength Index. By the way, it stands for Moving Average Convergence Divergence. It's complicated, but you never have to know that name. But what it does is simple. So I want to focus in on Elliott waves, which are these numberings that I have here in the letters, A, B, C, and then 1, 2, 3, 4, 5. And yeah, 5 is up here because we don't exactly know for sure exactly where 5 is. 5 might be here, for instance, on this chart of the S&P 500. That this is a chart that goes back, a weekly chart that goes back, I think, at 12 years, I believe. And trends go for a long time, many years. Matter of fact, this one that we're looking at here is one of the longer ones in U.S. history. And they unfold in 5 ways higher. And there's rules that govern what makes a wave and how long a wave is and how far retracements will be for the next wave and all that. And I'm not going to get into all that. If you want to know more about that, you can look up, and I believe this is just only online because I think the book is actually out of date, out of print, but it's a book called Elliott Wave Principle by a guy named Robert Balin, B-A-L-A-N, and he's phenomenal. There are other books out there on Elliott wave analysis, but in my opinion, they're very complex and they're very hard to understand. And of course, Elliott waves can get very complex if you want to try to learn every single pattern that could ever be out there. But the most basics of Elliott waves are that downtrends tend to unfold in 3 waves, which they label A, B, and then C. And then uptrends unfold in 5 waves, 1, 2, 3, 4, and 5. So what I like about those is that there's things that we can know about a wave by how far we are into one, how likely it is to correct, how far we are likely into that correction. We can know what the sentiment is at each and every wave. And so there's a lot that we can tell just by Elliott wave analysis, and that's one of the reasons why I like it. So again, I never expect you to learn the rules to learn how to count the waves or anything like that or whatever, but just conceptually getting the concept that there's 5 waves up in 5 major waves up in an uptrend, and 3 major waves down in a downtrend, and all of your advancing waves, which are waves 1, 3, and 5. So the numbers are at the end of each wave. Those advancing waves have 5 miniature waves within them as well. Waves 3 or 5 tend to be the longest of all those waves, and the corrective waves, wave 2 and waves 4, tend to more times than not have 3-wave pullbacks, which we see here, A, B, C, a little 3-wave pullback, A, B, C. Now sometimes you can have a 5-wave sideways move, which would just go 1, 2, 3, 4, 5, and then break out higher. So again, there wasn't a wave there. I'm just using my cursor to illustrate it. And that's a sideways range that can be long and laborious and boring, but yet when it breaks out, it can break out to, another really nice high. So, and one of the corrective waves, may be a sideways and one may be a three-wave pullback. But so what I like about it is, so when we know wave one is coming, we can count 5 waves up, and we know that wave one will be coming close to an end, and that likely either a sideways range for a while or a three-wave pullback is coming. And so while it's always hard to tell exactly where that three-wave pullback will come to an exact end, you know that there has to be 3 waves in the pullback, and wave C tends to be more times than not the longer of the waves. So you don't have to jump right back in until wave C is well underway. So you just let a wave, the A pull back, the B, which is the bear market, bounce back up, and then the C, let it get kind of long in the tooth, and then you can start going back into a position, whether it's a stock or an index. I happen to be using the S&P 500, but Apple stock or IBM or Google or whatever else you'd want to look at, they have these same patterns and same wave counts. So and then when they pull back, one of the things that you can know is that they tend to pull back closer to the major moving average, which is the 200-week moving average in this instance. If you were on a daily chart, that would be a 200-day moving average, depending on which time frame you're looking at, because there's Elliott waves on weekly charts, there's Elliott waves on daily charts, etc. So weekly charts are where one little candle of movement takes up a whole week, which is Monday through Friday trading, and then a daily chart is just 9:30 to 4 Eastern Standard Time, Monday through Friday. So it's one of those. It'll note one each and every day. So each day will be a candle in and of its own self. So and then downtrends, the thing you need to know about them is that they take a while to unfold. So everybody probably remembers the downtrend. Most of them remember the downtrend in 2008 because that's where the brunt of it happened. But actually the downtrend started where the last peak happened, which was in mid-2007. So it actually started in early 2007. But here's the nature of a downtrend. Is when an uptrend has been going for many, many years, and it had been going for many, many years up to this point of 2007, and most of that is not shown in this chart, people get so accustomed to it going up, they can never see a day where it's going to go down. And when it goes down, they can never see a day where it's ever going to go up. But the astute investor always looks for those potential turning points. They're not trying to call a top or a bottom. They're just open to and knowing that the tide will turn eventually, and so they're looking for that to happen. So in a wave A, that's the first down push of a downtrend, most people just interpret that as another pullback within the long uptrend because they don't realize that this was a wave 5 ending. And so they buy this dip just as heartily, if not more so, than any other dip before, because after all, buying any other dip before that worked out marvelously, and they're making money hand over fist. And by the time you're getting close to the end of wave 5, everybody wants to tell their boss where they can stick it because they're making so much money in the stock market at that time that they think they're a genius. And then the next downtrend unfolds, and they're humbled and reminded that they're not a stock market expert. They just happen to be in the latter stages of a bull market uptrend. And so it just felt like they were a genius. And downtrends can go very deep. This one happened to go from, on the S&P 500, 1576 down to 666. Horrible number, huh? Before it ended. And wave C tends to be the longest of the ABC legs, and they tend to have 5 waves within them, which you can see here, 1, 2, 3, 4, 5. And remember, waves 3 or 5 tend to be the longest, and most of the time it's wave 3, but sometimes it's wave 5. You see a very long part of the downtrend here. Just like in the uptrend here, 1, 2, 3, 4, 5, wave 3 tends to be the longest, but sometimes it can be 5. And there's reasons for that as well. So the reasons why C wave and waves 3 tend to be longest is because the new activity, the new trend has been in motion long enough to where enough people have caught on to it that they're piling on the trade. And also in the bear market, one of the reasons why C wave is the longest is because the fear gets so thick, and the doubt, and people second guessing themselves and second guessing their brokers and second guessing stock investing in the market and everything else happens in wave C. So it is the height of negativity, and it's why you can see the red bars here, the selling volume just growing up until close to time for the bottom. And what usually happens is much of the time when the actual bottom happens, sometimes the volume will even be slightly lighter than what it was at its peak, because pretty much everybody who was going to sell has sold, and now the selling volume is starting to die off, and that allows the trend to turn around. And you see here was the peak in negative selling, and the downtrend ended just a few months later on lighter selling volume, and then that selling volume started dropping back off. Now also something to note is that wave 2, even though you start a new uptrend, when this first wave 1 rally happens, this has been going for so long that nobody is positive on the market yet, and they think any bounce higher is going to resume the downward move, because after all, from mid-2007 to early 2009, everything told them that. Every rally up was just another disappointment to them and another leg down. So they're expecting, every rally up within wave 1 to be the next resumption of the downtrend, and that doesn't end up happening. So wave 1 is bearish, but wave 2 is even more bearish, because when it has that 3-wave pullback in wave 2, they're going, oh yeah, here we go again. Here's the next down leg of the downtrend. And so it's sometimes wave 2 can be even more negative sentiment wise out there for the masses than wave C, which is right here, which is wave C at the end of the downtrend. And sometimes wave C is just depending, but they're both the kind of the height of negativity is into wave C, into wave 2. And you'll notice, see this spike right here? This was the last straw for a lot of people, and this is why you have this spike up here in selling volume, and then it drops way off, and then it's just gone for the longest because the market takes off. So another thing to notice about the volume is that anytime you have volume that is 2 to 3 times what's average, so these spikes up here, notice the spikes up in selling volume, and notice that it was usually, while a very emotional time and a time when the media was usually very negative on the markets, it was usually a wrong thing to do to sell, because you look here and here, and they're selling here and here, and then just over the next year or so, I mean, it's way up here, again. They sell again really strongly here at the bottom of wave 2, and the market rallies strong for the next 3.5 years, and they're kicking themselves again. So the times when they are selling the most, especially when it's at least double or more the average volume of the chart that you're on, you can almost count on that people are making the wrong move. And it's at those times where it's best to be the contrarian. And when there's massive selling to the tune of 2 or 3-fold what's average, more times than not, it pays to be the buyer rather than the seller. And so here's kind of the sentiment of uptrends. So through wave 1 and 2, even though they're technically an uptrend, the masses haven't caught up onto it yet. The sentiment is still negative. The news media out there is still negative on stocks. Analysts are still negative lots of times on stocks as well. Institutions are building positions in here. They're buying and accumulating again, which is what has made the uptrend, but they're not coming out on TV just yet and telling you to buy, because they need you to be a seller so that they can buy your shares that you're selling. And they need you to be negative on the stocks so far so that they can buy it at lower prices. Because if they just go out there and go on CNBC or Bloomberg and say, hey, we're bullish on this stock and we think it's going to go to the moon, what's going to happen? A ton of people are going to go out there and buy that stock up. And what's it going to do? Shoot it up in price. And then the mutual fund or hedge fund or pension fund or whatever that wants to go buy those shares are now going to pay a premium for those shares, much higher price because they went on TV and blabbed. So the game they play is and this is unfortunate, but this is how it works. They stay very negative in the public and in the media while they're accumulating shares. And so through wave 1 and wave 2 of the uptrend, they're buying big time. But they're still negative and reporting negatively on those stocks. Then once they have their positions fully built, because remember, when you're a pension fund, hedge fund, or mutual fund, you're buying millions of shares over time. You're not buying 100 shares or 1,000 shares like you or I might do. Even if you have an individual buying 5 or 10,000 shares, which is a lot for an individual for any one stock, that's pocket change for an institution. So if they were to just hit a button and buy, a million shares of a stock in a moment, like you or I could go into a Ameritrade, E-Trade, Fidelity, Scottrade, Schwab account, whatever, and place a buy. If they place a buy for 1 million shares, like we place a buy for 100 or 1,000 or 5,000 shares, they would move the market on themselves and actually get worse fills on the tail end of their order, and they would pay a far higher price because their own previous buying volume would push up the price for their latter part of the order of their buying volume. So they have to inch into positions and inch out of positions because they're whales, so they have to move into these things slowly and exit out of them slowly, or else they'll move the markets on themselves. Not like us. You or I could sell entire positions if we wanted to, or buy entire positions in a moment, and we're not going to see on the chart where we move the market. So we're like fish, and they're like whales. So the sentiment is still very bad through waves 1 and 2. And the sentiment, surprisingly, doesn't turn positive usually until about halfway through wave 3. And this is where the public will start to buy in on the stock market, usually somewhere towards the latter stages of wave 3 or the latter stages of wave 5, or really anywhere in wave 5. So the half or more of the bull market is already in the history books by the time the retail public gets involved. Now, why do they wait to get in so late? Well, one, they buy off emotion, not facts. That's why they buy at high valuations and not low valuations. They want reassurance. They want a security blanket. And for them, the emotional security blanket is the market needs to have been going up for quite a while before they feel comfortable in getting in. However, there's a high price to be paid for that comfort because you're buying. Imagine what a stock price is selling for way up here when the S&P 500 is way up here versus what those same stock prices were when it was earlier on in the bull market. And you can't talk a person in the wave 5 is so through the roof overly optimistic for the retail public that you couldn't talk them into selling their positions for anything. And that's where the over optimism gets extreme. And down here towards the end of wave C, they are so pessimistic you could just sense it in the air. You could just cut it with a knife. And they're so pessimistic you couldn't pay them hardly to go in and buy stock shares anywhere in this period. So, and those are the exact times where you should be buying, or towards the ends of wave C's and the ends of wave 2's, and when you should be unloading them is towards the end of wave 5, and it's the time where you're going to feel least inclined to. When is fear most apt to grip you and you make wrong decisions? Towards the end of anywhere in wave C, pretty much, and sometimes in wave 2. When are you apt to make wrong and bad decisions in when to turn loose of your shares? When they've risen a lot and you've gotten greedy because you're afraid you're going to miss out on even more gains and you're unwilling to sell when things are towards the end of wave 5. And so what happens is people end up riding it all the way up and riding it all the way down. And why do they do that? They didn't have a good reason for getting into it, and they don't even know why they got into it, other than their brother-in-law got into it, or they heard some talk around the water cooler, or they heard TV rah-rah in it, and so they bought into it. Also, you will find that the news is some of the most positive towards the end of bull markets. This is like, if you notice, we're towards, at the time of this filming here, we're towards the end of another bull market, and um, tech stocks are on fire, and most stocks are on fire, but at super high risky valuations. So it's high risk, yet people don't know it. It's kind of like housing in 2007 and 2006. Housing had become way overvalued and high risk, but yet it didn't feel like it because people hadn't sensed the repercussions of that downtrend in housing prices yet. And then '08 happened, and their house price cut in half or cut by a third or whatever, and they got underwater on their mortgage, and then all of a sudden they felt the risk. So the risk is there before you ever feel it, and by the time you feel it and recognize it, it's too late. So that's why this is called the logical investor and not the emotional investor. You will never find me asking myself how I feel about a stock. It'll never happen, because how I feel about a stock will always lead me to do the wrong things at wave C, wave 2, wave 5, etc. So those are the times where the pro is making the prudent and right choice because they're staying logical, and the novice is making bad mistakes because they're emotional. So the novice, the retail investor, largely is emotion led. They'll call it gut, but it's really emotion led. They're buying because everybody else is buying. They're buying because it's exciting. They're buying because it's fun. They're buying because they think it's sexy. They're buying for the thrill of it. They're buying because everybody, quote, they know is doing it. They're buying because the people on TV are bullish and telling them to buy and jumping up and down enthusiastic about it. They're buying because it appears that the company is doing so well. But again, that has nothing to do with valuation. For instance, right now, where the stock market is overall, you've got Amazon stock acquiring company after company, and they're coming out with new lines of products all the time, and they're clamping down on a lot of their competition, and it seems like they can do no wrong. And their stock is through the roof, and their stock is in a wave 5. And the novice person out there will flip on the TV or surf the internet and see all this positive chatter about Amazon, and they'll go, hey, maybe I should buy some Amazon shares. And they're buying, Amazon shares at the peak of optimism. And that's where you are practically guaranteed to be overpaying for an asset. When are you likely to be underpaying for an asset, getting a value? When the pessimism is so great you could cut it with a knife. And when is that? Towards the ends of wave C, towards the ends of wave 2. So, if you go to college and you take a finance course, you're going to have professors that tell you what should happen in textbook, and they're going to tell you that there is an efficient market theory out there. And they basically say everything's baked into the cake, everything's always known by the market's trading efficiently, so there are no real values to ever be had out there. Well, one, if that were true, how does Warren Buffett beat the market by a wide margin over, a 30, 40, 50-year period? And he's not the only one out there doing it. And two, if stocks didn't have humans involved, it might could be close to a textbook of what it should be. In theory, theoretically, they're correct. The only problem is there's reality, and in reality, it doesn't play out that way. In theory, if a company earns more, it should be worth more. If it earns less, it should be worth less, again, over time. But what you'll find is that there's human emotion involved, and human emotion makes misjudgments. So I'll give you just a regular example. Have you ever gotten into an argument with a spouse, a friend, a sibling, whatever, and you flew off the handle and said stuff you didn't even mean to say? I mean, you said stuff you didn't even hardly know was in you to say. Well, what happened? You went from logical to illogical. You went from rational to irrational. And when you were on the illogical and irrational side, which is the emotional side of your brain, you just went haywire. And all kinds of stuff flew out of your mouth, and you caused a lot of damage, a lot of hurt. And then you have to go into repair mode and apologize your tail end off and ask for forgiveness, and takes quite a bit of time in the future for you to regain that person's trust, all because of an emotional moment that was irrational and illogical. So, and if you'd been in a saner mind, meaning logical and thinking logically, and you could just be an independent onlooker at that, you would see how ridiculous it was and how those words should not have been said, etc. And you'd be more sober-minded about it all. Well, so markets are emotional. They're sentiment-driven. And that's why there are values to be had towards the end of Wave C and Wave 2, because there's no positive outlook for stocks. There's hardly anybody wants to be a buyer of stocks at Wave C and Wave 2. So you don't have a bunch of competition going in when you're buying. So things are on sale in those times when the sentiment is atrocious. So this is why you can never say, well, gosh, why should I be buying? Because you're talking on TV like they're horrible. That's exactly the time you should be buying if you have a solid asset. And that's why I say it goes back to fundamentals in the end. You want a sizable company that has deep pockets, lots of cash on their books, low debt relative to their market cap, and that trades at a PE, a price to earnings ratio. In other words, the stock price relative to their level of earnings. You want that PE to be small, meaning that you're paying a small price per share for the level of earnings that the company puts out. And that scenario is likely to happen when you're towards the end of Wave C or Wave 2. And by the time you're, part of the way into Wave 3 or 4, you're for sure at fairly valued, and you're probably teetering on overvaluation. And by the time you get well into Wave 5, you could practically bet money that you're in a state of overvaluation, because people are competing with each other to buy. They can't wait to get in there and buy. They're just itching, chomping at the bit to buy because of the recent history in Waves 3 and 5 has taught them to buy every pullback. And it seems like easy money, and it seems like the bull market will never end. And how quickly they've forgotten the last downtrend because it's been so many years away. So towards the end of Wave 3 and Wave 5 is so far in distance away from the last downtrend that they've quickly forgotten history, basically. And they don't realize that there comes a day where this turns into this again, just like it did here. And uptrends eventually turn into downtrends, and downtrends eventually turn into uptrends. And the practical reason is because the prices go so far and they can grow so fast, but earnings can't grow nearly as fast. And so what happens is you get a stock price that is valued so high that, any number of years into the future, practically, they couldn't catch up in earnings enough to equate to that present stock price. So it's overshot and gotten way out of whack in its value, and that's why these downtrends have to happen. And it's like a reset. It washes all of the fast money out, the momentum traders out, the emotional traders and investors, the novice investors. It wipes them all out and washes them all out of the markets and takes the market from a state of overvaluation back to a state of undervaluation, which is a reset, and then it starts back up again. And it's always been that way, and it always will be that way. Now, people can say, gosh, it's horrible that downtrends ever happen, but they have to happen because people take them to excesses on the upside, and those have to correct. Just like housing was crazy overvalued. People that even had no experience in housing were buying secondary houses and flipping them, and it seemed like easy money. And they're thinking, gosh, I'm making $50,000 a house flip. Why am I working for this guy I don't even like, making $50,000 a year when I can, just be flipping houses, $50,000 a pop, and And, while the party lasts, that's true, but they don't realize the party's going to come to an end. And so there's a euphoria that happens towards the tops, and they lose their sanity pretty much. And they were willing to pay about any price for a house, and they were outbidding each other on houses, and people were buying second and third homes just to flip and so forth. And that's the towards the top of a market. And then there is a reset period where there is and downtrends are almost always 20 to 30% down, and some of them are 40 to 60% down. 2000, the crash of 2000 in stocks, the crash of 2007 and 8 were 40 to 60% drops from top to bottom. So, and a lot and that happens with any asset that gets out of hand, whether it's housing or stocks or whatever. I mean, there's things that get excessive that were in the past that weren't even a tradable asset, like a Beanie Baby or a Cabbage Patch doll or whatever. I mean, there's all kinds of stuff in the past that did that. So there's always excesses in the market, and the problem with emotion is it's normally hard to read when are you getting towards the end of the over optimistic side and when are you getting close to the bottom of the overly pessimistic side. And that's what Elliott waves quantify. That's what they measure. And that's how you take something that is irrational and is illogical, like sentiment-driven trading that drives stocks down too far, that drives them up too far, and it allows you to avoid a lot of the massive downtrend that happens, because you're able to know the phase of the market that you're in and the sentiment and the way the masses are thinking in that phase. Now, again, here's the deal. You're never going to call a top, but you will be able to avoid a lot of the downtrend. You're never going to be able to call the bottom. So never expect when you get in a stock that you've called the bottom and that's just going to go up from there. That is novice thinking galore. The pro knows that when they buy, even if they buy at a fundamental value, that the stock is still probably going to go down on them for a period, and then it's probably going to go sideways on them for a period, and then it's finally going to go up on them for a period. And that's why you need, when you invest in stocks, you need to give it at least 2 or 3 years or more when you're investing that money, because there's always that phase to it. And so one of the ways that Warren Buffett does so well in stocks is he won't buy in all of his position all at once. So let's just say this is a stock rather than an index, and it's been trading down here for quite some time, and it's gotten down to a point where it's a fundamental value, as noted by low price to earnings ratios or low price to book ratios, yet it's still a valid stock. It's a high market cap stock. It's got low debt. It's got deep pockets. It's got billions of dollars in cash on its books, etc. So it's a solid asset at a suppressed price, and it's at a low PE, so he'll start buying. But he knows, and honestly, he even hopes that it will initially go down on him more in the near term and not just turn and go up for him in the long term. Now the retail investor, they hope and pray that when they buy, one, they're going to buy in all at once, which is wrong, and they're going to hope and pray that it starts going up immediately, and that's a wrong expectation. The professional mindset says, I'm going to buy at a value, and I know that 9 times out of 10, I haven't called a bottom, and that a value is going to go even to a deeper value, because, again, it's an emotionally driven market, especially towards the end of a downtrend and towards the end of an uptrend. So it's going to get real irrational, which means a deep value can go into even a deeper value in the short to medium term. And so he will buy in chunks. So let's say he bought some here, and then he'll buy some here, and then he buys some here. And so his average break-even price is somewhere in the middle, and that helps get his average break-even price closer to the bottom, even though he didn't call the bottom. It helps gets him turned around and at break-even sooner than if he'd have gone all in earlier, and it gives him a greater long-term percentage gain in the end. So that's how he beats the market, with averaging in, with buying solid stocks at low PEs, and with having a lot of patience. Now, again, I'm not saying he knows Elliott waves. I'm saying he knows fundamental valuations. And so that's how he does it. But I'm quantifying it here for you through Elliott wave counts. So this is something that I just wanted to share with you and teach you a little bit about, so that when you see me going through charts and I'll say, well, this is probably in a wave C or a wave 2, or this is one wave 3, so it's probably got more to go, or it's probably got a pullback coming soon because we're at the end of a wave 1 or 3 or something like that, that you know what I'm talking about, and it becomes more English and more interpretable than sounding like I'm speaking a foreign language. So feel free to review this video 3 or 4 times, or even periodically every few months or so, because when I introduce a new concept to you, you're not gonna eat the whole elephant at once. So don't think it's strange if you don't understand this full concept right off the bat. That would be called normal. Elephants eating one bite at a time, and so big new thoughts, big new ways of concepts of investing and things of that sort. It takes a little while to get your head fully around them, and so just know that's normal. But also know that when you're following me through the Logical Investor newsletter, that you're not going to have to be an expert in any of this stuff or know how to do any of it. I'm the one doing all that, and you're just looking over my shoulder and getting inside my brain and hearing my thoughts about stocks and indices and economies and things of that sort, and what I think is coming in the future. And so how I know that a stock is very likely to go up in the future is one, if it's a solid company and it's a low PE, there's massive chance that it's heading higher over time. And two, if it's in an uptrend, I can see where it is in its overall wave count and know that it's got quite a bit more to go, or I can also know when we're pushing it to the upside. If we're already 5 waves up and we're well into that 5th wave, I know, even though I won't call the absolute tops, I'll leave some on the table, as every pro will. You will avoid the downtrend. So we have a way of measuring, when to get in and when to get out. None of it is top and bottom calling stuff. There is not such a thing out there. If somebody tells you that they can call a bottom or call a top, you need to turn around and run, because that's just not out there. Now, I'm not saying some people won't say it's out there, but I'm just telling you it's not out there. That's a fantasy. So, and that's why it's good to average into investments, and that's why sometimes people will even layer out. They'll sell some on successive rallies, because it's a way that they can bring their average sell price up and get closer to the top, just like averaging down got them closer to the bottom, but it didn't get them at the bottom or at the top when they were selling. So the goal in investing is not to catch a bottom or catch a top. That's what novice people get focused on. That's what traders get focused on, and they get burned. Investors know that they're not going to catch a bottom, they're not going to catch a top, but they do have measurable ways to know that over years, over 2 or 3 years or so, that if they buy low PE stocks that are huge companies and have huge market share, deep pockets and low debt, and they'll pick a point to buy them at an advantageous spot technically on the chart, along with it being low PE, that over time, over those years, they stand a great chance of beating the market. And then once they have a diversified portfolio of those stocks that they've averaged down on, that's their way to lower and mitigate risk. That way because remember, you don't have to win on every single investment that you're in order to win overall. They call Warren Buffett America's greatest investor, and he has not won on every single investment he's had out there. I remember him losing on the euro. I remember when he went in with a big silver position, he lost on that. And I remember him losing on a UK grocer. Just some of the ones off the top of my head that I remember they lost off of. So he does not win off of everything he ever does. So if you just hear about him nonchalantly, you think everything he touches turns to gold, but it doesn't. But so how does he win overall? He's got a diversified portfolio. He keeps a lot of cash on the side, and he layers into great solid assets, and he is the king of patience. He refuses to get emotional about any asset, and he'll stay logical about them. And your tendency as a subscriber is always going to be to get on the emotional side rather than the logical side. and it's one of the reasons why I named it the Logical Investor, because I want that word staring you in the face every time you go to my site. I want it to just scream logical at you, because that's what it's going to take to be the successful investor. And so there's a methodology, there's measurable metrics. When we look at fundamentals, there's measurable metrics. When we look at Elliott waves, we can tell sentiment in them. We can tell how far a trend likely is, as far as how long in the tooth it is, or when we possibly are getting closer to bottoms of downtrends, etc. There's other things that tell us that too in the indicators like RSI, MACD, and moving averages, but that's for another video. So thanks so much for watching. I hope you got a lot out of this, and God bless. Bye-bye.